Good afternoon, everyone. My name is Ronak Karamchandani, and I lead the Middle East Research Division for Preqin, a provider of insights and data to the alternative asset community. Thank you very much to the organizers for hosting this spectacular event, and thank you to everyone who can make it to this event here today. The topic for today's panel is, what does 2024 hold for hedge funds? So following a sustained period of rather calm markets over the past decade or so, when interest rates were low, inflation was moderately low, and geopolitical tensions across the globe were peaceful for the most part, we are now facing high inflation, rising interest rates, financial contagion, the war in Ukraine, a surviving pandemic, and increasing geopolitical instability. And so amidst this market of uncertainty, what does the near future hold for the hedge fund asset class? I would like to thank the panelists for being here today. I think we can do a quick round of introductions to begin with. So starting off with Manpreet, do you want to go, please?
Thanks, and good afternoon, everyone. My name is Manpreet. I'm the regional CIO at Standard Chartered Wealth Management. So we advise, obviously, our clients on the total portfolio allocations, which of course includes hedge funds and alternatives more broadly.
Thank you. Good afternoon, everybody. I'm Hussein Tantawi. I'm SEO of Iceberg Capital, alternative investment firm out of Abu Dhabi, multi-strat. Thank you.
Good afternoon, everyone. My name is Shiv Sehgal. I head capital markets for Nuvama, predominantly based in Mumbai and looking after Indian investments. But my background is 17 years in the hedge fund, long short across Asia. Thanks.
Hi, good afternoon. My name is David Rothon. I'm chairman of the Middle East Investment Management Association, which is the industry body representing asset management firms, including hedge funds. And additionally, I'm also the CEO for AD Global Investors, which is a specialist active fixed income shop out of Abu Dhabi.
Thank you, gentlemen. We can kick off the panel now. So on to our first question. So we know that global economic forecasts have remained modest as central banks and policymakers still try to address the issue of persistent inflation. Where do you guys see the overall macroeconomic environment going in 2024? And how do you view hedge funds as an asset class for the near future as well? I'd like to start off with Manpreet first, please.
Sure. I think when we look ahead at 2024, I don't think it's going to get any easier. I think the last couple of years have been unusually difficult in the sense that we're transitioning from one economic cycle to another, like you said, from a period of zero interest rates, which created one kind of environment, good for some strategies, not so much for others. And I think we're in the process of going back to a more normal, quote-unquote, environment where that baseline, neutral rate is much higher. But I think we are still very much in that transition where, look, if you look at some indicators, that argues for a much more difficult economic outlook. I mean, we've been of the view that the US still faces a not insignificant risk of an economic recession and all the market volatility that accompanies that. But the reality is we've also seen more resilience, more surprises than, many of us and our peers expected at the start of this year. So the US, of course, it's funny, I was looking at some of the economic models, and there's one that jumped out to me where we look at a simple growth inflation framework, and the model sitting exactly on the midpoint between recession and strong recovery. So what do you do with that, right? And it sort of sums up the kind of yo-yo environment where we've been in from, we're going for a deep recession to, everything's fine, let's not worry about it, just buy risk assets and everything in between. But I think when we look through that, we're still in the camp that, look, this will eventually, growth has to slow. It has to when interest rates have gone up so much. But when you then take an alternatives, a hedge fund sort of view, in our view, that actually starts improving the outlook. So yes, we deal with more volatility, but I think we're seeing more of a return of the traditional market correlations, macroeconomic relationships, which in our view, when we considered allocating to hedge funds, in the past cycle, that was one of the biggest challenges, right? You could just go long more to income assets. You could go long very simple risk assets and still generate a pretty attractive return. Why would you, get more complex than that? I think now we're getting back to a world where it's harder to, make money through those sort of strategies, and you're getting more the relationships normalize, looking back at the pre-2008 world, and that might actually look quite interesting for hedge fund strategies.
Okay, thank you, Manpreet. Over to Hussein.
Thank you. First of all, I'd like to thank this distinguished panel, and it's a very good question to start with. And just to keep it a little bit different, we tend to look at very deep research, including past cycles and time cycles. And if you take a 100-year view, which is something we do, if you subtract 100 years from where we are today, you will see that people back then lived through the roaring 20s, where you actually had a combination of hyper-growth, hyperinflation, heightened geopolitical tensions, which lasted for a few years, almost a decade, that saw extreme growth, followed obviously by the Great Depression of the 1930s. Now, I'm not saying that we're going to be hitting a Great Depression in a few years, but looking just at cycles, we're at the place where the hyper growth that's supposed to happen is happening, but because of, and a lot of people in this room are going to disagree, but the deflationary forces that are being created because of technology and the efficiencies of what some people would call the Amazon effect are actually keeping us exactly where my colleague here has said, that we're right in the middle between growth and inflation. So bottom line, I believe we're going to witness the roaring 20s again, and we are actually in the midst of this. And I believe clever hedge fund managers who are able to manage the volatility over the next 5 to 10 years will actually do very well. Thank you.
Thanks very much, Hassan. Over to you, Shiv. Can we get your opinion, please? Thank you.
Firstly, thanks Bhaskar and his team for putting up a great show yet again. I think it's a very interesting question, there's no doubt. I'll bucket it into 3 parts. I think there's no doubt, Manpreet made it very clear. We lived in a world for the last 15 years where cost of capital was almost nothing in the developed markets. And I think the key element here is, how do not only hedge funds, but even long-only asset managers view the regime going forward. I think there's no doubt that it's going to be very clear that your base effect of cost of capital is higher. I think there's enough financial press out there that we have been, the Feds and the central bankers are close to the ceiling. I think we keep plotting out, by 6 months as to when the real rate cuts will happen. I think also what's important here is to realize whether it's a soft landing or recession or not, the reality is that the economy and business impacts will be felt with the cost of capital going higher in developed markets. To me, 2 things are important from a macro perspective. One is China today, the negative press that's permeating across financial newsrooms, one, how does that play out? Are we closer to a Japan-style deflation in the 1990s? Or is it that if you look at since 2019 onwards, the Chinese banks have actually outperformed the US banks? So is the negative press justified? Yes, I'm not debating the fact that China is going through trouble. There is debt problem, real estate problems, demographic problems, geopolitical constraints, and they find themselves isolated. And there's a, very much, I think, the common prosperity goal has probably lingered too much. The interesting stat I'll just give you guys is that if the Shanghai Composite Index goes from 3,000 to 4,000, 21 trillion yuan of wealth will be created. And that's 21% GDP of China. The point I'm trying to make is that China is a very large economy. We cannot ignore it. And if the powers that be can get the animal spirits rekindled, I think for all long, because the reason I'm saying that is I was in Singapore and Hong Kong recently in the last fortnight. I've never seen equity and asset allocators so much negative on China as I see it right now. The contrarian in me tells me that we are probably close to the nadir in terms of fundamental thesis. The China market cap to GDP right now is 58%. Japan topped out at 140% in 89-90. The US right now is close to 170%. So just putting some stats out there, the contrarian in me tells me that if you can get your thesis right on China and play it right, I think there is a lot of money to be made from these levels. Of course, it's not going to be easy. The second part is how does Japan play out from here? For the last 15, 20 years, we start off the year and everyone's very bullish on Japan, and as the year fizzles out, so does the Japanese bullishness. This year around, given what's happened in the yen, I think it seems that Japan is actually seeing some inflation, which is very good, unlike the rest of the world. And of course, the third part to it is India. I'm not going to talk much about it. There are panels here. You'll hear a lot more about it. There is no doubt I'm extremely bullish on India. But more so, the last point I'll make is, in my mind, for every asset allocator out there, performance will be made in emerging markets. I think the EMs are the new DMs. There's a great book by Kishore Mahbubani, which says Asia in the 21st century, which talks about a lot what Bhaskar mentioned is what's happening in GCC, what's happening here in Dubai, in Abu Dhabi, in Saudi Arabia. And I think pockets and financial centers and gravity of money will move to these centers, and that's where the growth corridors will be. And the challenge remains is finding liquidity in these markets, but I think that will improve. So I'll stop here.
Thanks very much, Shiv. David, over to you.
Okay, I'll see what I can pick up and see what's left on the table for me at the end. Well, I guess, clearly it's a challenging environment. We've seen rates go and financing rates go from sort of 0 to 500 basis points or thereabouts, which clearly impacts cost of funding for both at a firm level, but also in capital market pricing for equity valuations. Potentially gives a bit of a headwind to the cash-based hedge fund strategies, the CTAs and the long short. So they're obviously enjoying a sort of a 4% to start with. So I think there's definitely some opportunity going forwards in the next 18 months. I think one of the things to really watch out for, and I guess there's two camps of hedge funds here, those that do need to raise capital and those that don't need to and just looking to navigate the markets. Those that need to raise capital, they're going to have to get the story quite tight in what I've seen. I think the capital market assumption groups, whether it's investment consultants or family offices or fund of hedge funds, obviously the price has been, there's been a lot of repricing across asset classes, and I think hedge funds will have to find a home for that within that new world.
Thanks, David. I'd like to just go back to Sid's point. Sid said he was quite bullish on India. Shiv, you said you were quite bullish on India. The rest of you, what regions are you sort of bullish on next year?
I think from a regional perspective, it varies by asset class. I think so India is of course one we are as well. And I'd say both slightly different views cyclically and structurally. I think we're actually much more constructive structurally. When you think across the next business cycle, there's much more on the policy framework, infrastructure development, potential growth, and high productivity that I think makes us structurally bullish. Obviously, from a cyclical perspective, we'd be happier if valuation entry point was a bit cheaper, on the equity side at least. But I think as part of a broader Asian sort of allocation, we think that's interesting. On the equity market side, Japan, I think, was another one I heard mentioned. And I think that's one perhaps investors are not enough investors, I think, have picked up on as yet. Because, look, Japanese equities have seen these sort of rallies within the broader bear market, but I think for the first time we're starting to see some structural shifts. Inflation, whether it's taking hold or not, I think is an important question. Signs are positive, but I think that's obviously a call we'll only know whether we're right well after the fact. But we're seeing some improvements on corporate governance, which as an investor, of course, start looking quite interesting. So those are, I think, some regions, and I think more you'll see in the Asian side as opposed to Europe or the US at this point in time, where we prefer a bit more of a narrower approach just because of how much more expensive the markets are. The other question we ask ourselves is, again, would we take exposure to equities or bonds or the currency? Because we have the flexibility to do so. And I think when it comes to China, the doom and gloom, I think we're still in that phase where we'd either take investment grade exposure or take a very narrow company or sector exposure. And I think that's sort of one area, or frankly, just high quality duration in dollars. I think that's sort of the spectrum of what we're looking at as topics at the moment.
Thanks, Manpreet. Hussain, what are your thoughts on that?
Well, I'll tell you what we've been up to. So as of a month and a half ago, I would say we're almost 100% allocated to UAE equity markets. So that's where we see the opportunity. Definitely India is on the radar. I'd like to see some repricing, but overall, overall you cannot ignore India. But in general, emerging markets, and actually China is starting to look very interesting for us as well. But bottom line, from what we're actually doing is re-shifting back to UAE markets, which we believe are going to do very well.
All right, thanks, Hussain. David, any thoughts on that? Sorry, I think Shiv, you wanted to jump in?
No, I just wanted to make point that I think irrespective of which geography you look at it, I think the key element here is, I think most investors in this room, I'm not talking a gloom and doom scenario, but I think your risk premium for every asset class needs to be repriced when interest rates have gone up to the extent they have in the last 12, 18 months. So, the point is, I think we are in for a little bit more volatility in the next 12 to 14 months to 18 months. I think that is a given, and I think we need to brace that. The central bankers have, starting with the Greenspan put, every time there's been volatility. I think the key element here would be whether we get a soft landing in the US or not, and how that plays out in terms of what the central bankers do. But I do feel that we are being quite benign in the volatility regime, whether it is FX, whether it is macro, whether it is equity. And I think, given what's happened with the large 7, 8 names in the US, or you can extrapolate that to any other economy or any large market, I think that pullback or a change in a structural regime shift there could be elementary in the next couple of months. Passive strategies may see some sell-off. It's a catch-22. When they're buying, they're all buying the same names. When they're selling, they'll be forced to sell all the same names. And that gives me the one pocket where I feel that it will create a lot more volatility than what we have seen in the past. So if you can stick to your main elements of core strategies and not deviate too much from them, that's where the real money will be made.
Yeah, well, I think one of the points mentioned earlier, maybe expand on that. I think there's a definite, there's a DM, EM story that's taking place. Obviously, developed markets clearly have their role and have been probably a little bit late in terms of monetary policy, whereas the emerging market countries have been earlier in terms of raising up interest rates. So I think there's probably some pretty interesting opportunities both on the equity side and the fixed income side on emerging markets. Obviously, it depends on what strategy you're employing as a hedge fund or as a long-only manager, which I guess you can't say that in a conference like this. But clearly, I think the EM side has got some good opportunities in the next 18 months.
Thanks, David. Moving on to my next topic of discussion. So I want to talk about strategies. What strategies do we think are going to perform best going into 2024? So traditionally, we've seen equity and macro funds as the big winners historically. But as interest rates rise, credit strategies are gaining momentum as well. So what are your thoughts on the strategy perspective, Manpreet?
Sure. I think when it comes to hedge fund strategies, I mean, we tend to break it into 4 big index buckets. And I think there are 2 that jump out in particular, right? I think number 1 is obviously looking at just equity long short. And for the simple reason, I think when we describe the macro context we're in, we're at that point where we don't take risk exposure off the table, but neither do we want to double down, triple down, and have excessively concentrated exposure. So how do you do that? I mean, when you think in the long-only world, that gets quite complicated, about how much do I allocate? But that's where long short becomes quite nice because, yes, you give up some of your upside in a big equity bull market, but actually being able to, have more sort of downside volatility protection actually starts looking quite interesting in these kind of times where trying to get the balance right. So that's, I think, one side of it. And on the opposite spectrum, I think macro strategy is something we've always had. Spend a lot of time looking at, thinking about, sometimes successfully, sometimes not so. But if our broader macro thesis that US growth has to eventually slow down, if we're right on that, I think that's an environment in which what we often refer to as the insurance-like characteristics of discretionary macro strategies particularly, I think that starts looking quite interesting. This is in fact the only point in the whole cycle where those start adding a lot of value. So obviously many other details and other strategies, but those are the 2 that really jump out in the macro environment we just described.
Perfect. Thanks, Manpreet. Hussain, over to you.
I think you're going to see outperformance in long short for the guys who know what they're doing in terms of actually navigating the volatility. I think macro will do well. I think credit will continue to be okay. But what will be different is the tools that let's call them the surviving managers, that are using today to create this alpha are completely different than what they were 3 years ago, definitely 5 years ago, and for sure 10 years ago. So the tools like alternative data, access to very private, personal information that, consumers, in terms of their behavior, make and have. These are really being utilized. And so bottom line, strategy-wise, I think the strategies that have done well this year will continue to do so, but the tools to really fine-tune the alpha for next year, because of how complicated the picture is, are going to change, and they continue to change every day.
No, I completely concur with that. That's very well said. I think absolutely right. I think as I mentioned in the previous comment as well, that active strategies, I think, are in for a lot more, I would say, volatile time, and as such, they'll be able to kind of pick up the market inefficiencies that come in the next couple of months. The other point which we have not discussed here is, I think, the emergence of the HFT and the quant strategies that we are seeing, not only in the developed markets, but in emerging markets as well. And we are seeing very significant amount of capital getting deployed by these strategies. And we also run a prime brokerage in India, and I can see the kind of P&L being generated, and I think that's one strategy which cannot be ignored, has done very well, especially in India, and I think other parts mimicking as well. And they're becoming significant players as the overall volume in most exchanges. And I think one thing that we have not discussed is commodities. I think to me, while we've been in a very benign world and global growth seems to be on a softer ticking, on the flip side, while that is happening and China has had problems, and China sold 10 million units a year, and if that deflates, that has an impact on commodities, and they were the largest importer of commodities for the last 2 decades. But the reality is that we are seeing oil ticking up, and that's been in a benign world. So if global growth does pick up next year, commodities, to me, I think, given the lack of capex that's happened in the last couple of years, I think that is one strategy and asset class that cannot be ignored as well.
Okay, I'll take a slightly different angle to this. I think obviously the gentlemen on the panel have done a great job there on some of the hedge funds that are going to do well and types of strategies. I think from a more of a sort of a macro level, I think harnessing technology and some of the disruptive technology that's coming into play at the moment, I think those that are able to sort of harness that, whether that's a pattern recognition software to help the traders or the fund managers, is going to be quite important, along with those that have the financial firepower to withstand some of the regulatory burden that's coming down the track, whether that's taxonomy being applied to hedge funds, whether that takes place. It's certainly had a big impact to the European fund industry. Whether that impacts hedge funds remains to be seen. And clearly those that can benefit from the consolidation in the industry, there's a lot of big players that are picking up and hoovering up the assets, and a lot of smaller players that are producing great returns, but not necessarily can't withstand some of the regulatory burden that's out there. So I think those are some of the key things to watch out for.
Thanks, David. I do want to move on to the investor perspective now. So next year, going into 2024, how do we think investors are going to be viewing the hedge fund asset class? Do we think they're going to increase, maintain, or decrease allocations towards the asset class going into 2024? Manpreet, over to you.
I think to some degree it will depend on what recent performance look like, I suppose, to state the obvious. I think there's an opportunity and there's more competition. And again, just taking a private wealth perspective where we tend to think of the whole multi-asset portfolio, I think the opportunity is that one of our constant bugbears has been that the allocation to alternatives more broadly has always been lower than what we'd advise clients to do. So I think that's the opportunity, and that's obviously combination of hedge funds as well as private markets. I think the competition, of course, is obviously there is a recency bias amongst investors, particularly on the individual private wealth side. So obviously looking at what returns look like in the past cycle, for example, right or wrong, tends to have a big influence. There's also the question mark over hedge funds versus private assets. I think that's another source of competition to say, okay, when you think about an alternatives allocation, from our point of view, both add a lot of value. When you think about adding value to a multi-asset portfolio, but again, how do you think about getting the balance between the two? I think that's going to be another question. So I think the good part is, like I said, more opportunity to grow that allocation. I think more willingness on the part of investors to ask these sort of questions. Whereas if you go back 3-4 years, it was a simple case of, well, I'll just buy equities or I'll buy an income asset and I don't need to think beyond that. So I think it's a question of how of course, hedge funds take advantage of that opportunity.
Thanks, Manpreet. Hussein, any thoughts on that?
Yeah, what a great question. Basically, at least in my opinion, I don't think a lot of people will disagree about this. Hedge funds in general are probably the most effective tool that investors have to get access to risk-adjusted returns. I mean, that is a fact. Another alarming fact, though, is there's more than 30,000 hedge funds in the world today. I don't think there's 30,000 Burger Kings in the world today. So that's a big number, which usually means some are going to fail. The other fact is that investors today are at the most sophisticated, educated, and have access to so many different options that if really your product is not amazing, and I mean amazing, it's going to be very difficult to receive serious capital. And like my good friend Dr. Basgupta mentioned earlier, that even I'm shocked to see that the big guys are actually outperforming, and I can easily see why the big guys are going to be the ones who continue to receive allocations in the near future, because of the tools that they have. So there's a lot of attention on risk management, on analytics, on new tools, and there's maybe a handful of hedge funds in the world today that truly do reinvest their 400 or 500 million of management fees that they do get into making their product better. And it's these guys that are going to receive the allocation, I believe.
No denying that. I think you're spot on with that point. I think one key theme is that, I've been coming to Dubai for a couple of years. The fact that we have a room full and I see some people standing because there are not enough chairs just tells you how successful this event is. And the other point is that the intellectual and the human capital that is required in this region from hedge funds, and coming to your point that some of the largest funds are now looking that took off in Singapore, and what transpired in Hong Kong actually resulted in a lot of benefit to this region. A lot of funds, a lot of large companies, a lot of intellectual capital moving here in the last 2-3 years, and I think that's going to be an element for sure, which is going to drive the returns here for this region as well. Because suddenly you don't only have people who are looking at trading in India or Hong Kong or London, looking at those markets, but coming here and realizing, okay, what can we do and what kind of strategies can we deploy in the MENA region and the Gulf region. So I think, the point I'm trying to make is I think my view of the world is going to be a lot more volatile than we are used to, given the cost of capital where it is, and it's not coming down anytime soon, unless there's a big risk of event and central bankers have to, cut rates significantly, which would inherently mean that there's been an event that has caused volatility. And as a result, hedge funds will be back in the prime where from the last 5-6 years there's been the passive markets, passive money driving things. I think returns in the risk adjusted basis capital will find itself back into hedge funds.
I think in part from an investor perspective, obviously it really depends on the type of investor you're speaking to, whether it's an endowment foundation, pension, sovereign or central bank. Obviously they have different strategic asset allocation and investment objectives, but just anecdotally, I was in Singapore and Sydney last week, and certainly there's been a reframing of what they need to do from a strategic asset allocation perspective, and hedge funds certainly have a huge role to play, is the feedback we were getting. Certainly, this has probably been one of the most hated bull runs in equity market history this year, and obviously fixed income's had a pretty decent run this year in comparison to last year. And obviously moving forward from where we are today, where rates are inflation and wherever you sit on the growth story, there is, we need some uncorrelated returns to those mainstream asset classes, and hedge funds are there to really sort of pick up the slack there and actually take probably a slightly larger share than they have done historically in that space. The problem being, though, the large hedge funds are saying, well, we don't necessarily need to have that capital at the moment. So there's that sort of conundrum at the moment in terms of where do they find the talent to increase capacity? Do they hoover up smaller firms to increase capacity? And so that's one of the sort of the challenges that I heard from the investor side.
Thanks, David. I think we got time for one more topic of discussion. So given this volatile environment we're currently in, there are a few key challenges for return generation that investors are currently worried about. A few that come to mind, obviously, are stock market volatility, rising interest rates, asset valuations, geopolitical landscape. In your view, what do you think investors will view as the key challenges for return generation in the next 12 months?
I think you mentioned quite a few key ones in that opening. I think, look, one is, I think the level of rates is something we've all discussed. I think that's going to be both an opportunity and a challenge. Obviously, more opportunity to generate on the fixed income side, but obviously setting a higher bar for many other asset classes. I think volatility is definitely an opportunity because we've gone from, again, many years of low volatility to we're seeing it rise across several asset classes. I mean, just as an example, I think FX volatility was absent for several years till we finally saw it come back. Fixed income vol, of course, looking very, very interesting. And it's not just at a top-level asset class, but also we're seeing greater dispersion within sectors, intra-stock correlation starting to fall. So all of those, again, if you're following very either specific types of strategies, that can be quite beneficial. But how those evolve, if we continue to see that dispersion stay in place, I think it's a second opportunity. And third, maybe one I discuss is, valuations, because I think that's the overarching one where obviously short-term, a lot of the other factors create opportunities. I think as a long-term investor, valuations are the ones we still worry about. I think they're better than where we were, let's say, a couple of years back. But for some markets, at least like the US, I think or India, it's still one that we're not completely comfortable with.
Thanks very much, Manpreet. Hussain, your thoughts on that?
Sorry, Rhoda, could you please repeat the question?
What do you think investors will view as the key challenges for return generation in the next 12 months?
The almost 9% risk-free rate. I mean, that's, it also depends on the kind of investor you are. So there are investors who are very happy with 9% a year, and then there are other ones who are unhappy with 9% a month. So, but if I were to, guess, and I'm probably going to be wrong because I'm usually wrong about these things, but if I were to pin one down, it would be people hoping that the Fed is going to lower interest rates next year and actually making a bet on that, and that would just be irresponsible where I come from. Thank you.
So for me, I think the key theme is where the large pools of money will find attractive investment opportunities. In the early 2000s, it was China. Then we have seen what's happened to the NASDAQ. And this is not a question for 2024, but to me, as you rightly said so, how do we assess what the Fed is going to do and where interest rates will be and which pools of money will still find investment opportunities? And I do feel that I'll come back to my opening statement, which I think emerging markets and the corridor of Asia from MENA, India, Southeast Asia. I think, that is the largest population belt. There is an aspirational middle income group, which is consuming at a very fast pace. And I think that's the key element to me. That's where growth will happen. I think the developed markets are going to struggle to drive growth in a world where they're not used to the cost of capital. That's where we are about to see. And that's going to be the key theme for me.
I guess one of the areas to consider is, the ongoing geopolitical tensions and what that means for capital flows, in particular around, a potential move from the public to the private sector and what that means for asset returns, as there is potentially a lack of confidence in governments. Obviously, bond markets 20, 30 times the size of the equity market. If that moves in any meaningful fashion into private markets, then obviously there could be a big push up in levels there. So I think keeping a close eye on the geopolitical tensions is quite of a key one that feeds into a lot of other factors, whether that's in inflation, central bank as well.
All right, thank you very much, gentlemen. I think that's all we have time for today. So thank you very much for your time, and thank you very much for attending this panel. I think everyone's got a good insight of how hedge funds are going to fare in 2024. Everyone, if you can please give these gentlemen a big round of applause, please. Thank you.
Thank you.
Thanks, everyone.
Good afternoon, everyone. As I've already sorry, this was meant to be for the start of the presentation, but as you all know, my name is Ronak Kromchandani, and I currently lead the Middle East Research Division for Preqin. I initially wanted to kick off this presentation just giving a few insights that we have on our hedge fund database on the Preqin Pro platform. So just going to give you guys a few trends that are currently trending, from our hedge fund data on the Preqin Pro platform. So Preqin's hedge fund dataset consists of over 7,500 active hedge fund investors, over 10,000 active hedge fund managers, over 31,600 active hedge funds, and over 530 hedge fund benchmarks on the Preqin Pro platform. Hedge funds ended 9 quarters of pre-COVID outflows before the tide turned in 2020. We can see from the chart above that for 9 consecutive quarters, from Q2 2018 to Q2 2020, there were a series of outflows before LPs turned to the asset class again in Q3 of 2020. The asset class also hit a record high of AUM earlier this year in Q2, as the AUM of the hedge fund industry was $4.37 trillion US dollars. Turning over now to hedge fund performance and strategies. Since 2019, we can see that equity and macro funds have led the way, finding alpha in turbulent markets and outperforming other strategies such as credit, relative value, multi-strategy, and event-driven. However, we can also see that in times of turbulence, high beta strategies like event-driven and equity funds usually see the sharpest drawdowns as compared to strategies such as macro, CTA, and relative value. Moving over to the investor perspectives towards the hedge fund asset class, in our most recent investor outlook survey, we could see that LPs are increasing allocations to credit, relative value, and even fund of funds over 2023 and into 2024, while slowing down on more volatile strategies such as crypto and equity. 48% of LPs are looking to increase allocations to credit funds over 2023 and into 2024. With higher interest rates, hedge funds eye more opportunities in the credit markets. And so the key takeaways are the first half of 2023 saw hedge fund asset flow reversal after 3 quarters of outflows. AUM stands at $4.37 trillion, marking the highest AUM for the asset class. Equity and macro funds are the strongest hedge fund performers since 2019. However, macro and relative value provide the best downside protection in times of volatility compared to high beta strategies such as equity and event-driven. 48% of LPs are looking to increase allocations to credit funds over 2023 and into 2024, as higher interest rates are causing hedge funds to eye more opportunities in the credit markets. And finally, there are currently over 10,000 active fund managers and over 30,000 active funds in the space, with 30% of fund managers on the East Coast in the USA alone. This was just a short slideshow, guys, because given the interest of time, I couldn't present, obviously, the whole presentation. But if any of you have any questions, please do feel free to come up and ask those questions during the networking session this evening. Thank you very much for your time.